Greetings, everyone, and welcome to our February 2025 quarterly macro and market update with our Chief Investment Officer, Michael Dow. I am Julien Frazeau, your Deputy Chief Investment Officer at Beacon Pointe, and it is my pleasure to be your macro and market moderator today. So we've got a lot to cover, but before we bring Michael in, just a couple of housekeeping items. So we have budgeted 90 minutes for this webinar, because we have more than 60 slides to cover. We also receive a lot of great questions for our audience, and we want to ensure that Michael has time to address as many as possible. So we already got a lot of questions, but if you have a question, please type it into the Q&A box at the bottom of the Zoom screen, and we will do our best to address it throughout the presentation. Please note that the recording of the webinar will be available at beaconpointe.com/videos approximately 24 hours after the conclusion of today's live event. So what's on the agenda for today's call? In the first section, Michael will discuss the policies of the new administration. In the next section, we will do a deep dive into growth, debt, and deficits. In the third section, we will discuss the current state of the US economy, inflation, and the Fed. In the fourth section, we will delve into the AI momentum and the concentration risk at the top of the US equity market. And as usual, we will wrap up the webinar with how to position portfolios in the current environment. Without further ado, let's bring Michael in.
Julian, thank you very much. I always like to start the webinars with this particular slide and to say thank you all for joining. I'm actually here live in the Big Easy with the folks in our NOLA office. Thanks very much, guys, for letting me to camp out here for a bit. Looking forward to a great discussion today on all of the topics. We've gotten a lot of questions, and there's not many answers yet, but we're going to do our best to dig into the issues that we think are likely to move markets and to help us position your portfolios for alpha generation and for capital preservation. The key here, and again, this is the slide we always present up front, is what do you need to know about to really manage the money? How important are these things versus other things that you may be hearing? And the answer is these are the only important things. If you can figure out where you are in the business cycle, that is, where's the economy, and if you can identify what the inflation dynamic, the directions of inflation dynamics, then you know what the Fed cares about. And the Fed's the interest rate setting body that actually is determinative of the PE multiple that applies to the equity market. So if you know where interest rates are headed, you at least know what kind of PE multiples can be supported, so you know kind of where risk assets are headed. The other piece of the P and E multiple, besides the interest rate component, has to be corporate profit, so earnings. So if you know where you are in the business cycle, you can get a handle on inflation dynamics, you can get a handle on where corporate profit growth is heading. And those are the two things that help you understand where the equity markets are. And of course, directly inflation and what the Fed's doing helps understand where the bond market's headed. So what is the current economic outlook? Again, starting with the conclusion, right now we figure we're probably in a no landing scenario. Could be a soft landing. There's no imminent signs of recession now. Could reaccelerate, which would be an issue. But currently, no landing means the labor market's pretty stable. The Fed is likely to be on pause for a while, and no slowdown on the horizon. That seems to be the most likely scenario now. What about inflation? The Fed's not in any hurry to lower rates from here. We got an inflation print yesterday with CPI coming in a little hotter than expected, and with the unemployment rate at or near full employment, it doesn't seem like the Fed's got any scope to maneuver at this point. So we're going to be on hold for a bit until the data tells us different. And again, because we're not, it doesn't look like we're headed for a recession anytime soon, our view is, particularly here in the US, that corporate profit growth is likely to be supportive of equity prices, even though, as we've seen, two great years in the S&P, both years, 23 and 24, greater than 25% growth. So it's pretty spectacular environment. There's a lot of good news priced in, but these are the important things. The things that don't matter, really, that you're going to hear about on the news, particularly maybe CNBC and other things. There's going to be a lot of noise, and our job as your advisor is to identify what the signal is in that noise and to try to make sense of it, and that's why we're doing this webinar today. So want to make sure we get your questions answered. As Julian mentioned, there's a Q&A box. Don't hesitate to use it. I always start with a bit of an overview of the global economy and the JP Morgan Purchasing Managers Indices that we're seeing here on the left. The global PMIs give you a pretty good sense of what's happening in global manufacturing and global service growth. And what you can see is if you're above 50, that means that the global economy is got a tailwind behind it, and it could be in expansion mode as opposed to contraction mode. We spent a little bit of 2024 in contraction mode in manufacturing, but services, that's the orange line. Global services has been on a tear. It seems to be cooling a bit, but overall, you can see within these indicators that things seem to be a-okay. And also, we want to see what the trend is. So while the PMIs are pointing to expansion, the global composite purchasing manager indices, which we've got on Z-scores here on the right, green is good, yellow and red is not as good. We do see some slowing across the global economy, and it seems to be concentrated primarily in the emerging markets. For example, it's Brazil, India, and China that seem to be contributing to the a potential slowing of economic growth globally. But all in all, we're coming off 6 months ago, 9 months ago now, pretty solid global economic expansion. And there's no signs of a recession globally, which we take as a pretty good sign, as a foundation for U.S. growth and as a backdrop for taking risk in risk assets. What contributes to global growth more than just about anything? Monetary policy. So is monetary policy tightening across the globe, or is it is easing? And you're seeing a little bit of divergence, or you were. Now what you're seeing is that the rate hiking cycle is definitely over. Both developed and emerging markets are cutting rates. And we are seeing now some meaningful reversal. On the left side, you see how many rate cuts and rate hikes there were in the last year. On the top and on the bottom on the left, you see how many rate cuts in the last 3 months. And there's been many more rate cuts in the past 3 months than rate hikes. And on the right-hand side, you see a composite of the emerging market central banks, which there's 2 different scales here, obviously. The emerging market central bank rates are in the kind of the 8.5% and 9% range, off a peak of 9.2, whereas developed market central banks also cutting more quickly and more meaningfully. You see from a peak of about just under 4% down to just under 3% for developed market composite central bank rates. So the market's in an easing cycle. That's generally supportive. We think it's likely to maybe be on pause for a bit, given that we've seen a bit of a reversal, but there's really no signs of a global recession, and that'll keep central banks concerned and wary of cutting rates further in the near term. A couple of quick snapshots of the macro environment. GDP is strong here in the U.S., and we'll see a slide that shows the quarterly forecast for GDP is right smash packed on top of potential, getting us to a 2.2% reading. That's forecasted for 2025 on top of a 2.5, 2.9, 2.8 in the last 3 years. It's really shockingly consistent and just slightly above potential growth, which has caused some of the inflation issues that we're currently seeing. With growth above potential, you always worry about potential for inflation, but as it's come down from this peak of 2.9 back in 2023, the CPI and the PCE, personal consumption expenditure, are both cooling. The unemployment rate has ticked up a bit, but seems pretty stable at this point, but it was at 50-year lows, so it's not likely it would have gone any lower. So we've just got some basic macro numbers here. I want to dig in a little bit to the GDP numbers on the next slide. The breakdown of GDP, as we all know, GDP is composed of consumer spending, government spending, private investment, exports and imports, which is net exports. So it's GDP equals C plus I plus G plus X. We talk about things are quite solid here in the United States. It's why we feel like the Fed's going to have a chance to maybe not be as aggressive cutting rates because inflation remains a little high and there's just no storm clouds on the horizon, at least looking backwards. There might be some uncertainties going forward, which we'll dig into when we talk about the future, as opposed to what we're looking at here, which is the recent past. Just to put a bow on the recent past, these are the capital market returns in the equity markets. In growth land, you've got NASDAQ here I've highlighted. All country world indexes on the far left, and emerging markets on the far right. I've got 2022, 2023, and 2024 here. 2022 is obviously the horrible year for equities. It was in the midst of the Fed rate hiking cycle. And what you saw is the NASDAQ, which has the higher highs and the lower lows, taking it on the chin, down almost 33% back in 2022, but then coming back strong with a 30 and a 45% year in 2024 and 2023, respectively. So the S&P 500 I've highlighted here as well, plus 25 last year, plus 26 the year before. Nice recovery year after being down 18% in 2022. There's no better argument to stay invested, especially when things are looking bleak. Coming from 2022 and having the two recovery years in 2023 and 2024 are pretty good evidence that under most circumstances you should stay the course. Here are the bond market returns for the same. It was the worst year in bonds ever back in 2022, but we've had some steady years, although 2024 was kind of meh, except for the riskier bonds, U.S. high yield and emerging market sovereign debt. But munis, up 1% or 2, up 1% in last year and 6% the year before. U.S. core bonds, which are the taxable bonds, corporate bonds, treasuries, and mortgages, up about the same, 1.3 after being up 5.5% in 2023. You generally see a recovery in bonds. There is a bit of a reversion to the mean. If you have a really bad year in bonds, what you know for sure is that the go-forward yield is going to be higher. If prices go down, bond yields go up. So if you have a bad year, you've got now a starting point of higher yields, and that's a pretty good indicator of where the bond market is headed. I want to dial in a little bit to capital market returns on certain assets in the run-up to the November election, and then in the period subsequent to November 5th. And on the left-hand chart, you've got assets, Bitcoin, 10-year yields, small cap stocks, the US dollar, and gold, and they're normalized so you can get the percentage change from September 18th, plus or minus, which is about the same time that the probability of a Trump victory was being priced into the markets and went from about 45% up to a high of about 60%. During that same period of time, this is what people are referring to as the Trump trade. You saw things like Bitcoin and 10-year yields up very sizably. Also, gold had a nice run in the run-up to the election. And that's on the left-hand side. On the right-hand side, now you've got post-election to 2 days ago, Bitcoin continuing to steam ahead. But more worryingly, perhaps, you've got 10-year yields that have continued to increase. And with 10-year yields and gold up, you can make a story out of that makes sense, which is there might be some concern about the budget, tax cuts, what tariffs might do to growth, and other things related to the Trump policy priorities, which we're going to go into some detail on, that might have longer-term unintended consequences related to the U.S. dollar and the U.S. as a reserve currency, but they certainly have potential negative implications for the supply of U.S. treasuries that are necessary to plug the budget gap if you're going to cut taxes, et cetera. Julian, do you have a question?
Yes, I guess I was just going to preview the next section. We received a lot of questions from the audience, and including today live, lots of questions about the Trump administration and the impact, the policies on trade and taxes and immigration and what it means for portfolios. So a lot of excitement and a lot of, I guess, as well, worries about what the uncertainty.
Yeah, there's no question that there's a flurry of activity in Washington, D.C., as there always is at the very beginning of a presidential administration, but this one even more so, which we'll see in a few slides ahead. What I'd like to do now is dig into the policy priorities, the ones that are currently being addressed in Washington and ones that will be addressed later. And many of you have seen this slide before. The overview can really be summed up in about 5 different broad categories: trade, tax reform, deregulation and cost cutting, immigration, and Federal Reserve policy. And the primary policies that have been communicated to the markets are tariffs on China. That's been implemented now of 10%. Maybe tariffs on aluminum and steel. We may actually get an announcement while we're talking today. Modi from India, the PM of India, is in Washington meeting with Trump right now, attempting to negotiate a potential deferral of tariffs on Indian imports. We've had the Canadian and Mexican tariffs, which were announced, paused for 30 days at least, and maybe more. What the market is currently assuming, just to jump to the conclusion, is that maybe a lot of the tariff announcements are a negotiating tactic. Certainly, the market has not been pricing in a complete implementation of all of the tariffs that have been announced. It would not be hovering near all-time highs if it was. Tariffs do have some positive effects and some negative. We're going to dig into tariffs quite a bit in a minute. But all it takes to implement a tariff, as we know, is executive action. So you don't need Congress. I've highlighted for trade and cost cutting. Those are the two that are top of mind right now. Taxes are going to be dealt with in the second half of the year. We need a reconciliation. We need a budget that's coming. We got one now out of the House. The Senate is going to go a two-track method as opposed to one big beautiful bill, probably. So there's a lot of negotiation and a lot of coming together between the House and the Senate that needs to be addressed before we can talk about what the tax laws might be that are going to be in the president's budget. But deregulation, cost cutting, and trade, and by the way, and immigration, we haven't seen a ton about immigration except for the executive orders, some of which have been put on the back burner by the courts. And Federal Reserve policy, haven't heard a peep about, which is great. You really want to make sure that Jay Powell and the Federal Reserve Board of Governors maintains their independence, because if you don't, it's going to be very challenging to keep the bond vigilantes from driving interest rates much higher if the Fed is perceived to be losing any of its independence to the administration. So we're going to talk about trade policy and deregulation and cost most in the next couple of slides. But first, I want to mention what are the constraints. So the implementation, obviously on the far right, it's important to know how you implement these things and what the constraints might be. There's very limited constraints on the president. However, he is using a novel legal strategy. It's by identifying the International Emergency Economic Powers Act of '77 as his basis. He's basically saying tariffs are legal, imposing tariffs are legal in order to stem the tide of illegal immigration and illegal drugs. I'm not so sure that applies as much to Canada as it may to our southern border. And that's a fair question about whether or not it does apply to Canada. And the Canadians are pushing back but those tariffs have been deferred. In terms of deregulation and cost cutting and the efforts of Doge and Elon Musk, what you've seen is that there's probably a limited legal basis for some of these programs, now it's been approved by the courts as of in the last 24 hours, the deferred resignation program for September. But granting the access to personal data, shutting down agencies that have been established by Congress, there's going to be a lot of court action there. That's the constraint on deregulation and cost cutting, and that's how the process works. The executive branch is attempting to expand the powers that it has normally used in the past, not necessarily extra legally or extra constitutionally yet. That probability has increased, but it won't be a constitutional crisis, which is if you do a Google search, I think constitutional crisis has gotten a lot of hits in the last 2 weeks. It isn't that until there's a complete rejection of a Supreme Court order or a Supreme Court decision, and we're not going to see that anytime soon. We'll talk about how the process is going to work through. And just to put a fine point on it, the markets are also a constraint on the administration's policies. There's no more readily identified scorecard for Donald Trump's success than the level of the stock market. So if there's policies that are being implemented that are going to, we're going to see pushback. We're going to see pushback in terms of the courts first, or the markets, coincidentally, but probably not from Congress. Those are the three areas of pushback, and we'll talk about the path dependency of that in a sec. But first, I'd like to start with what we're seeing. It's total shock and awe. We never saw 26 executive orders on the first day. Joe Biden signed 9. Trump in his first administration signed a total of 5 executive orders in his first week. In the second Trump term, now it's 62 executive orders. So it's been a flurry, and you usually get this honeymoon period in the first couple of months of your administration. We're at peak, I think, peak influence, probably peak popularity. You see on the right-hand side, Trump's approval rating. It's actually just a percent or two off of his all-time high at 47% in the first 2 months of an administration. So job approval ratings for January and February for all of the last 8 or 10 presidents are here. It averages about 60%. Trump, when he came into office in 2016, in his first 2 months, had a 44% approval rating. So he's near all-time highs for Donald Trump. And that means, and with the markets not having any kind of a significant pushback, either 10-year yields haven't risen dramatically or the stock market hasn't gone down, it seems, and he's won a few court cases and lost a few court cases. So what we're going to have to do is just work our way through some of this policy uncertainty. The election uncertainty is over, obviously, but the policy uncertainty remains, and there is implications for significant levels of policy uncertainty, which we'll talk about. But it's been a very unusual first 3 weeks of an administration. Now, I want to talk about cost cutting just for a second by digging a little bit into a pretty boring topic most of the time, but I think it's really important to understand just how big the federal budget is and what are the size of the government outlays. And on the left, you've got revenues of just under $5 trillion. Most of those revenues come from a combination of payroll taxes and individual income taxes. Maybe surprisingly, corporate income taxes are about 10%, no more, of the revenues that the government generates. But if you've got outlays, which is all the government spending in the middle of almost $7 trillion, inflows of 5 and outlays of 6.7, you're going to have a budget deficit. And the budget deficit for the actual budget deficit in 2024 was 1.8 trillion. That's trillion dollars. That's billion with a T. And what I mean by that, that's a number that's very hard to imagine. And it's very hard to find a lot of cost savings that can put a dent in it. Coincidentally, and a more significant point about the outlays in the middle, what you see in the green bucket of 4 trillion, that's mandatory spending. That is not appropriated by the government on an annual basis. That is, there's already laws on the books that make the spending on Medicare, Social Security, and Medicaid mandatory and automatic. There is nothing for the government to do, for Congress to do, not the government, but for Congress with the power of the purse. There's nothing for Congress to do that can materially change the mandatory component of the federal budget spending, unless you change Medicare and Medicaid. So we're going to see how that plays out. So that's the place you need to attack if you want to make a dent in the budget. The discretionary spending, which is primarily think about health and welfare, housing, education, and the big chunk is defense. Half of its defense budget is 1.8 trillion. Coincidentally, 1.8 trillion, exactly the same as the budget deficit, is discretionary spending. What you might conclude is if you wanted to close the budget deficit instantaneously, you could do so by not having any discretionary spending. You don't need to touch Social Security and Medicare. But if you're not willing to basically cut the defense budget to zero, and nobody is, or the other services budget to zero, which nobody is, then you really have to take a hard look at the mandatory spending components of the U.S. Federal spending budget. Julian.
Yeah, I guess what would be the implications, of these cuts to the economy? Like if Dodge is successful, they can cut 1 or 2 trillion of expenses. What are the implications?
I'm sorry, I lost you for a second. Could you repeat that, please, Julian?
Yeah, there was what would be the implications to the economy? If Dodge is successful at cutting 1 to 2 trillion of expenses, what would be the impact on the economy?
Well, it would be a combination of good and bad. The good would be by reducing the budget deficit. By the way, 1 to 2 trillion is a number that you would cut over the next 5 to 10 years. It's not possible to cut $2 trillion out of the budget. Most of the discussion of the federal budget relates to the outlook over the course of the next 10 years. So we have to be really careful about what we're talking about here. The idea that cutting federal spending would have a negative impact on GDP to start. but it would also have more salutary effects for long-term interest rates and productivity and the reallocation of resources in the United States, because less budget deficit is lower budget deficits, lower national debt. Those are all very, very worthy goals. So it's not clear to me that you can say with that cutting waste and fraud, that's a big plus. Everyone can agree that that's a huge plus. Cutting expenses that have been appropriated by Congress, that's been voted and Congress is voted on by the people as well. There's a mandate from the Congress to provide certain services and spending for sure. It's important to keep these things in balance. Julian?
Just following up on that, I guess with the next question is that will preview the slide. Why does actually the US even need to deal with the budget deficit? Don't we have the reserve currency?
For now, I think what's important to remember is the reserve currency status that we enjoy, which keeps interest rates lower here and provides a base for US dollar and a base of demand for US dollar denominated assets, has been an incredibly potent source of growth here in the United States, keeping interest rates low because other central banks and other countries demand US dollar denominated assets because we are the reserve currency is an unambiguous benefit to the United States. We are the reserve currency. There is no other option right now, but you don't get to be the reserve currency forever. We're not the only reserve currency in the history of reserve currencies. The Dutch guilder, the Spanish peseta, the UK pound, all of these were predecessors to the US dollar as the reserve currency, and they lost their reserve currency status through, generally speaking, debasing the dollar by printing too much money and or fiscal imprudence. So fiscal probity, fiscal debt sustainability, incredibly important, very important to maintain it, and that's the only way you retain reserve currency status, along with a couple of other features like being the largest economy in the world with the highest level of transparency, ease of doing business, lack of corruption, things of that nature, having a powerful navy to keep open trade routes, waterborne trade routes. So these are the things that make you the reserve currency. But the things that you can do to damage your status would be to run budget deficits for as far as the eye can see, and or print money without any constraint, which we're not seeing now, but budget deficits for sure, which we'll see on the next slide. And over time, you will erode the benefits that derive of being the reserve currency, but you'll never lose it until there's a substitute, a credible substitute, and there isn't one on the horizon right now. Speaking of budget deficits and where we stand right now, this is the CBO's projections from last month. The Congressional Budget Office, that's their job, is to produce budget data. We haven't had a balanced budget here in the United States since the late 90s, early 2000s. That's 25 years ago. And with the great financial crisis back in 2009 and with the COVID spending of 2020, what you have is a couple of periods of significant budget deficits, but persistent budget deficits, including a primary budget deficit. That's net of interest costs. You need to get a primary surplus, and you need to reduce net interest costs to reduce the deficit. These things are not likely, at least under the current framework and the current laws that we have. But there are a lot of things that can be done. There's a lot of enthusiasm about what's happening in Washington right now in terms of rooting out corruption, rooting out waste, because clearly, I mean, the General Accounting Office has already identified several hundreds of billions of dollars over the last couple of years that is obvious waste. I'm going to talk about what DOGE has done so far in a second, and what the size of the hill that they have to climb in a moment. But I just want to reiterate a couple of things. It's not all bad news as it relates to the budget deficit. In the CBOs, I'm looking at the chart on the right, there was $1 trillion of deficit improvement over the current 10-year horizon, that is from 2025 to 2035, in the most recent budget pronouncements from the CBO. And that's a positive. That is, the CBO, which is charged with making these forecasts, is able to, adjust for certain positives. That is, they found another 2 trillion of tax revenues and another 820 trillion of spending. The reason that the chart on the right is important is part of what the narrative that's coming out of Washington has to be laying the groundwork for extending the Tax Cuts and Job Act of 2017, and maybe making these tax cuts permanent, at least for 5 years. And the only way that gets through the reconciliation process and past some of the deficit hawks in Congress is if you can make it work in terms of what are the impacts of the tax cuts, and is there offsets in spending elsewhere, or finding of fraud and waste and things that can justify lower revenues without having a significantly negative deficit impact. And right now we're nowhere near that. Right now, the conversation is revolving around about 3 trillion of additional debt and deficits, and that we probably have to close that gap. Although there's some dynamic issues there where with lower taxes you could expect maybe some higher economic growth, but those things are very hard to imagine. So I'm going to talk a little bit now. Just right, what we're looking at here on the left is the Doge savings that is posted on the website to date. It's under 50 billion. The size of the total 2024 outlays is 6.8 trillion, and targeting $1 trillion in savings seems like a pretty big hill to climb. And you shouldn't expect that we're gonna get there in year one. I would say that the Doge effort to find waste and fraud is really compelling to the folks that I speak to in Washington, D.C. Some are concerned, but most are enthusiastic about it. And we don't know this for sure, but what I'm hearing from some of the folks I talk to is that the ability to find waste and fraud is enhanced by the use of artificial intelligence. And hence, that's part of the reason why the access to some payment systems across the federal agency platform has been necessary, or at least required. But it does cause a lot of uncertainty because it's a very novel way to go about it. And as a result, what you're seeing is a significant spike in policy uncertainty. Policy uncertainty does have implications for economic growth. And I think we're in a bit of a period here where we're in the eye, not the eye of the storm, we're in the storm. And the news flow, some of what we're hearing coming out of DC, and again, I try to limit my conversations with both clients and frankly with policymakers to very middle of the road here, very let's stick to the facts. And right now the facts suggest that a lot of folks who are market participants, a lot of folks who make decisions in the real economy don't have a clear view of where policy is headed. And that's the message for today's webinar. There isn't a clear understanding of where this is all headed. Hence, policy uncertainty has increased, and that tends to have a dampening effect on growth going forward. So I'm just going to highlight that fact that what we're talking and what you're hearing out of what you may hear out of the headlines may not be exactly what's going on, and there's probably a subtext. One of the subtexts I mentioned on the prior slide happens to be we've got to find some ways to get to a point where the Tax Cuts and Job Acts can be reconciled, and where revenue savings can be found to justify the voting for some members of Congress to justify voting for an extension of the tax cuts. And that's really the narrative that I'm hearing. Okay. Who knows what $1 trillion looks like? I think this is an important exercise. I'm going to take 30 seconds here and just say it's a half an inch big, $10,000 in a $100 bill. If you stacked up $100 bills to get $10,000, that's what it would look like. If you have $1 million, it's that little teeny tiny pile. That's a pile of $100 bills that equals $1 million. To get to $100 million, you need a pallet. One big pallet of $100 million in $10 bills. You need 10 of those pallets to get to $1 billion. This is the interesting point I'm trying to make. Going from $1 billion to $1 trillion looks like this. 1 billion is 10 pallets. That $1 trillion pile, if you look in the far left-hand corner where it's magnified, that's $1 trillion. So the job that it requires to make a dent in the federal budget requires a significant effort to not just root out waste and fraud, but to really tackle the issues that are driving the budget deficit. And those issues are almost exclusively related to the mandatory spending items. And it may take a combination of factors. Right now, federal outlays are about 23% of GDP, and federal tax revenues are about 17%. That's the 6% budget deficit you see. So you need to close the gap, and the gap either has to be closed by reducing spending or increasing taxes. And the only place to reduce spending is in the mandatory budget areas if you want to make a real impact on this. So we expect to hear more about that going forward. So I talked a little bit about what the constraints are. And the constraints are threefold. The courts are a significant constraint on what's happening in DC. It's part of the process. If there's perceived grievance, if there's a perceived wrong being done, the courts are the natural place to adjudicate it. Interestingly, the markets have been and Congress have both been surprisingly quiet as it relates to putting a constraint on what's happening in DC. These are all legitimate ways of getting from point A to point C. This is point B is the courts, markets, and Congress. And some are quick to react. The courts, obviously, lawsuits came fast and furious. The markets are also quick to react, but they haven't yet. And with the administration testing the limits of executive authority, you're just going to go through this process. You're going to see a lawsuit filed in a district court, a federal district court. It's going to get appealed. The administration is going to respond. It's going to either go away or die, or it's going to be appealed, and it could be appealed all the way to the Supreme Court. The markets are likely to react to the response of the administration and the courts if there seems to be a disconnect between those two things. If the courts make a ruling and the administration keeps on pushing, the markets may respond. Congress, which should be involved in some of this at some point by altering the laws as opposed to making laws specifically using executive action. There's quite a few of the federal agencies are created by Congress. To completely dismantle or defund them probably requires Congress to be involved, but they've been quiet to date along with the markets. It's really what we're talking about here, and in an attempt to sort of formulate a thesis about when will the markets respond. It's probably at a point when there's some disconnect between what's happening at the administration and what's happening on the judicial branch. Haven't seen that yet, and we probably won't. And if we don't, then everything is likely to, we're going to work through a very furious period of activity in DC. Again, our job is to try and assess what the signal is from the noise. And I think there's a fair amount of noise coming from both sides. And our job is to stay focused on the markets. Let's talk about tariffs. So we've got quite a few slides to get through. Going back to the 1820s, tariffs have been a significant component of revenue to the government. Back in the 1820 to 1920 timeframe, during that 100-year period, the average tariff was about 26% on all U.S. imports. Tariffs were the main source of U.S. government revenue. We didn't even have an income tax until 1913. But once we got an income tax here in the U.S., tariffs declined as a source of federal funding, and for the last 100 years or so, about 6% has been the average. The estimated rate of tariffs on all imported goods, if enacted, the 25% on Mexico and Canada, in addition to the 10% on China, would get us to about 7%. And that would be very high in recent history, but not that high in recorded history. Tariffs do alter and have distributional effects. They do raise revenue for the U.S. Government, but they also have a tendency to raise inflation, and they might actually cause the U.S. to maybe lose jobs. So the estimated effect, this comes from the Tax Foundation in Washington, D.C. It might increase unemployment by 20 bips, not a big deal. But where you see tariffs maybe having their largest impact, if they were all implemented, which again, nobody believes at this point that they're going to get, well, it may happen in 3 weeks, but right now there is no 25% tariff on Canada and Mexico. And I think most of it is a negotiating tactic. That's what the markets have said so far. But if they were all implemented, it might increase inflation by just under 1%. I think that would be bad news for the Fed, because it also has a tendency, tariffs have a tendency to reduce overall growth. It's distributional, so it reduces some areas of growth in the United States, but it obviously is a benefit for U.S. domestic producers. But the overall effect is to reduce growth by less than 0.5%. These are estimates, and they're the only one that I focused on right now is the increase in inflation. That seems to be the most likely path for, or the most likely outlet for higher tariffs would be higher inflation. But the Fed would be put in a very challenging spot if it also caused not just an increase in inflation, but a slowdown in the economy. The combination of those two be what I call a whiff of stagflation. And that would make it very hard for the Fed to continue to lower rates as we had anticipated. No more so now, less so now do we believe that the Fed's going to cut rates in 2025. Maybe one cut, but it would be zero if we got, I think, all of the tariffs. They would have to wait and see what the data said. Who's in the firing line when it comes to tariffs? Both Mexico and Canada have, in the lower left here, you've got in the far left lower quadrant, that's countries that have trade deficits with the United States and trade deficits that have gotten worse over the last 8 years. So where are the countries that we currently have a trade imbalance? Obviously, Mexico and Canada. China, not so much. China's, we do have a trade deficit, a pretty significant trade deficit, but it's improved dramatically in the last 8 years, and that puts China in the upper left. Most of the countries are kind of aggregated. This is in billions of dollars, so you can see our primary trading partners are here. Taiwan, Vietnam, Ireland, Germany. These are the countries, along with Canada and Mexico, that not just have a trade deficit with the United States, but have a trade deficit that's worsened. So let me try to put it all together and suggest that deregulation and cost cutting has implications for growth, inflation, and debt, some of which is good. Tax cuts, generally bad for the debt. And by the way, most of the inflationary impulses are the result of pro-growth type policies, which are unambiguously good. In a strong or a fully employed labor market, they become somewhat inflationary. That is, if you goose the economy with unemployment at 4%, it's likely to put upward pressure on prices, particularly through the wage channel. So the reason that inflation is generally higher under the macro implications here, as they sum up, is a residual effect of the fact that we're already at near full employment. So it's very challenging to promote pro-growth policies when you're at a fully employed situation. In terms of progress on the debt, clearly cost cutting would be very positive. Clearly tariffs would add to revenue. The immigration policies we haven't talked about, and tax cuts, we haven't talked about them either. So I'm going to leave those off. But I would just highlight that the overall effect of the policies that we've heard about so far would summarize to moderately higher growth, probably put a floor under inflation, and maybe provide an upward impulse, but some progress on the debt, which I think would be very positive. Here's the wild card. If you add policy uncertainty, when we're going to get through the policy uncertainty in the next couple of months, I have a prediction that we're not going to be talking as much about Washington, D.C. 3 months from now as we are today. We're going to do this again in May. And at that macro markets webinar in May, if we're still talking a lot about policies and what's happening in Washington, we should still be talking about the debt. To me, the debt and the deficit is the main issue of interest. But policy uncertainty is likely to go away. And when it does, I think we'll be back to fundamentals, and that will be a very good day, I think, for all of us who are responsible for our clients' assets. What's happening with the markets? So since January 20th, when the president was sworn in, stock market's up 3%. This is the global stock market, by the way. Non-U.S. stocks are up 3%. You've got U.S. stocks up 1%. You've got interest rates about flat, and you've got some pretty spiky volatility. This would be DeepSeek, and then this would be the tariff announcements. But then you've got a persistent rise in some commodity prices, not oil and Bitcoin, They're down from the 20th, but Bitcoin particularly, it was up 50+% in the last 4 months. So being off 6% is really nothing. But it's gold that we should be focused on. Gold has had a pretty stellar run year to date. It's had a really pretty good run since last September. And there's a couple of reasons for that, which we've talked about. I'll just highlight one or two. One is gold is generally a geopolitical risk asset hedge, and it's also a hedge against US dollar devaluation. So back to the question earlier about whether we care about debt and deficits, the answer is as far as it relates to reserve currency status and the supply of US treasuries that are needed to plug the gap between tax revenues and expenditures, which the difference is the budget deficit. More supply of US treasuries to plug that hole equals higher interest rates over time and a loss, really, of the demand for US dollar denominated assets. So where does that demand go? Sometimes it goes into gold. So I think that's what we're seeing right now is concerns, gold prices up on concerns over the budget deficit. If we hear any good news, better news about progress on debt and deficits over the course of 2025, which, by the way, there's really two things to be aware of. It's not so much the level of debt and deficits that matter. It's debt and deficits versus GDP. And if GDP, if you can produce higher levels of growth, then you can sustain higher levels of debt and deficits. You can really supercharge a decline in your debt load if you boost growth at the same time that you're providing a little more fiscal prudence. And that would be really, I would say, the plan A for any administration would be to do that. So I'm hopeful that we can see some progress on that score. So it's debt to GDP that matters, and getting GDP up higher is always a plus. So let's jump into what I think are the short-term market implications. And what I think you're going to see for stocks. Stocks are blue, bonds are green, the dollar is purple, and volatility is in the red. So it's likely to have you're likely to see stocks outperforming bonds in large part because a potential for interest rates to stay where they are, higher for longer, or maybe even edge up higher as we get through some of the policy uncertainty of the first months of the Trump administration. U.S. denominated equities are likely to outperform non-U.S. Developed equities. You could see a reversal of that outlook if there's some progress on the Russia-Ukraine war, and if oil prices come down. I think you could see potential for non-U.S. assets to continue to outperform. They've actually outperformed year to date, and they're likely to. That would continue if you see good news coming out of Europe. Credit's likely that's investment grade corporate bonds and high yield and municipals are likely to outperform treasuries. Certainly, they're going to outperform cash, but certainly treasuries, if longer dated treasuries, if interest rates go up, then short-term bonds are likely to outperform long-term. Strong U.S. dollar, that has been a theme up until about a month ago. And volatility, given the uncertainty of the implementation of policies and policy uncertainty, is likely to remain somewhat elevated until until we get to May. I don't know if we'll be talking about it as much. So getting through the policy uncertainty is really the most important thing. I have talked a lot about debt. I'm just going to highlight the fact that the Congressional Budget Office has suggested that we might be headed towards 144% debt to GDP. We need to get back to 100. This is the highest levels we've seen since World War II, and huge debt levels have a tendency to dampen your to growth and increase your risk. You have fewer degrees of freedom, and I really think the administration and the Treasury Department, the Federal Reserve, all policymakers in Washington D.C., Congress in particular, and folks that are represented by members of Congress, which I assume is everybody on this call, should write their representatives and let them know the debt is the #1 issue going forward. It has to be addressed, and I think you're seeing certainly a lot of disruption of prior ways to deal with it in DC, and the hope is, and it should be viewed as some enthusiasm for potential disruption to get some stuff done, it could actually be positive for the debt level, and that's the big hope. This is my favorite chart because it's got everything on it. The debt level, if you want to know, the national debt just crossed 36 trillion. More importantly, what we're spending on the debt has doubled from 1.5% as an average cost on Treasury debt to over 3%. And what that means is a combination of higher debt levels and higher interest rate payments increase the interest paid on U.S. Treasury debt, and that's just math. In terms of the deficit, we see 5 or 6% for as far as the eye can see, and this is the same debt to GDP chart, highest level since World War II. We really just I like including this chart because it highlights the fact that we really do have a problem. Washington, we have a problem. We've had a problem for 40 years, well, for 25 years since we balanced the budget last, and it's time to address it. Here's the key chart as well. If you have over 14% of all of your tax revenues, and we talked about tax revenues being about 5 trillion. As soon as you start spending more than 14% of that 5 trillion on debt service, interest expense, that's historically been the indicator that you have to move from accommodative to more restrictive fiscal policy. And we're over 18% now. This is 14% is not arbitrary. It's based on an assessment of cost of debt versus revenues over the last 50 years, and it seems to be a threshold that matters. So we're well above that now at closer to 19% and with no end in sight. Julian.
Yes, I guess it's time to move to our next section, and we're going to talk about the U.S. economy, inflation, and the Fed. And I guess the U.S. economy is strong, and now the question is, inflation is moving higher. Inflation expectation is also moving higher. So what's the next move by the Fed?
So I'm going to go through a couple of slides very quickly and just highlight the fact that GDP, which the components are on the right, but overall GDP for the coming quarters, it's remarkably steady in terms of the blue chip economist forecast. Very, very unusual to be this consistent. I guarantee it won't be those numbers, but the outlook is very sanguine for the U.S. economy. Strong growth, smash packed right on top of potential. In terms of the forecast for PCE inflation, it looks like it's coming down in a gentle way while growth remains stable. So that would be a soft landing, the combination of these two things. And in terms of the Fed funds forecast, it used to be pretty that we were heading for a normalization. We're at 4 3/8 right now, and the expectation is for maybe 1 or 2 rate cuts, 1 or 2 in the next year. So maybe 1 in 2025 and 1 in first quarter. We just want to know, I want to know, where is the landing strip for normalization? Where is our star? That is, where is the neutral rate of interest? This is the questions about inflation and what the Fed's doing are absolutely the right way to think about the short term. The long run issue is debt and deficit. The near term issues related to asset prices are going to be driven by what the Fed does. And we don't know. We don't know where the landing zone is. Is it 3 1/4? Is it 4 1/4? If it's 4 1/4, we're already there. And the Fed maybe could declare a soft landing. I think it's lower. Most Fed officials think it's lower. All the Fed policymakers I speak to think it's somewhere on the order of 3.5 to 3 3/4. So we're almost there, but not quite. And in fact, if we have to turn back the rate cutting cycle and return to some rate hikes, then we're going to delay that the landing at the normalized real neutral rate at some point. Are we going to get a recession? Blue chip economists, you saw that steady state 2% GDP for 2025. There's a 20% chance now, which is even lower than last month. Probability of a recession, very low probability of recession. I talked about the landing strip here. We're currently at 4 3/8. This is really the key. We just don't know where the Fed's headed, and until we can get a handle on it, and it's an unknowable number, but it's impossible to declare a soft landing just yet. We'll know in hindsight if this was a soft landing, and it will be a soft landing if our star is 4 3/8. If our star is 3 3/4 or 3.5 or 3 1/4, we're not there yet, and you can't declare a soft landing. We do a lot of work on our team, Nick Coletta, Julian, and others on the investments and research team to try to understand where we are in the business cycle and to try to see where the trends are in terms of the leading indicators, inventory levels, leading economic indicators themselves by definition, financial conditions, which tend to lead economic growth by 4 quarters, and sentiment. And combining all of these together in a heat map, things are looking pretty good as of the end of January. You've got some very positive numbers here. The only thing that seems to be perhaps negative is the U.S. trade-weighted dollar, which is which, as it rallies, tends to make exports more expensive for our trading partners. As it declines, it makes exports cheaper. So folks that export, like, and maybe there's some issue here with the, in the tariff calculations as well. But overall, if you put all of these things together in a heat map, it looks pretty good. If you put them all together into one index, it's basically telling you pretty benign outlook. This is a combination of the leading economic indicators and inventory, financial conditions, and sentiment. And it basically is telling you there's not a strong signal. Generally, you get a pretty sizable decline before a recession. These are recessionary periods back in 2001 and the great financial crisis here. And we could have this really, I highlight this cup of coffee recession we had back in April, May, and June 2020. But you got a significant signal there. But we're not seeing anything. We should have got a recession. I thought we were going to have a recession, certainly back in 2022 and 2023, and we positioned the portfolios defensively for the potential for a recession because, in large part, economic indicators are pointing that way. Specifically, the financial conditions index, and I would characterize, and this is a disaggregation of the overall series into its 4 component parts. Here you've got leading economic indicators in the red and the financial conditions indicator in blue. And what I based our view on 18 months ago is the fact that there was a significant downturn in the financial conditions index. That is, economic or equity volatility was high, the equity market was getting crushed, corporate bond spreads were widening. All of the things were pointing to a tightening of economic conditions in the future, but we never saw it in the real economy as shown in the leading economic indicators here, which kind of blew right through it. There wasn't as much of a signal coming out of the sentiment and inventory indices either, but this is the thing that threw me. I thought we were going to have a recession. I'm just going to say the payroll data that came out most recently in February, pretty good. The labor market's steady. The Fed may have scope for a few more rate cuts, but maybe not. Right now, with the unemployment rate at 4%, that's too low to cut, and more maybe to the point, and what the Fed cares most about, and this is why they're definitely not going to cut rates in March and maybe not even in June, is that average hourly earnings or wages were up surprisingly a little higher than expected, 0.3. That was a pretty big move. So that's what the Fed cares most about, and that's why they're not going to cut rates anytime soon. I do want to highlight that there is some cracks. I mean, the consumer has been really strong to date, but there is a canary in the coal mine, and that's consumer credit. And what you see on the left is the consumer loan delinquency rate, and on the right is credit card delinquency rates. And while they're nowhere near where we saw levels of the great financial crisis, which were close to 5% for consumer loans and almost 7% delinquency rates for credit cards, we are seeing a pretty significant move off of very, very low rates of delinquencies, and that's a potential canary in the coal mine. Let's go back to the main point at hand, which is effectively inflation. So we're looking at an actual inflation measures here. You've got CPI core at 3.3, CPI headlines at 3%. Kind of stuck in the mud here. We got down to 2.5% on headline CPI, down from 9%, which is great progress. Great progress, but it's getting from 3 to 2, which is the Fed's target. That's going to be very challenging going forward. So progress on reducing inflation is stalled. We saw that in the CPI print yesterday, and that's why the Fed's going to stay on hold. Here's the most important slide of the presentation. The most important thing to know about what the Federal Reserve's doing is what is the market's expectations for inflation going forward. The orange line is inflation expectations using the Treasury inflation protected securities market. So this isn't a survey. This is exactly what bond participants are saying they think is the best guess of inflation for the next 5 years, 2.7. What's the best guess for inflation from years 2031 to 2036? So the 5 years ahead, 5-year forward. That's the Fed's best measure of inflation fighting credibility. That's longer term. That's years 6 through 10. This is years 1 through 5. This is years 6 through 10. Right now, we're at the upper end in years 6 through 10, I think, of the comfort zone. So it's still green. but we're now starting to bump up against levels of inflation expectations for the next 5 years that have caught the Federal Reserve's attention. And they will not be able to cut rates with inflation expectations for the next 5 years well above 2.5%. And if they get much higher, the Fed will start a rate hike cycle. You'll see here it was this significant and rather violent move upward that caused the Fed. They thought this was transitory at the end of 2022. You remember the talk of inflation being transitory and inflation expectations. And it did come down at the end of 2021 and into 2022. But then by March of 2022, which is when they started the rate hike cycle, you saw a significant spike in inflation expectations for the next 5 years. And the Fed had to address it. They had to raise rates fast and high quickly to make sure that inflation expectations were re-anchored at levels that they're more comfortable with. Not surprisingly, if you look at 10-year averages of both 1 to 5 year inflation, that's this number. Sorry, that's this number, and 10-year average of 6 to 10-year inflation or longer-term inflation, they are both darn near the 2% Federal Reserve target. So that's what the Fed's aiming to. That's a good outcome for the Fed. If you can get some of these numbers closer to 2, but at 2 3/4 and at 2, almost pushing up against 2.5 here, these numbers are heading towards the caution or danger zone. They're not in the danger zone yet. Danger zone, 3%. If inflation expectations get above 3%, then you have to start perhaps pricing in not just the probability of no Fed rate cuts, but the possibility of them being on pause for much longer. And the next step, of course, is to price in a rate hike. There's just more information on inflation here. Supercore on the right is what Jay Powell was focused on for a long time. Supercore inflation are services without taking out shelter and housing. If you take out shelter and housing, this is core services. It's the stickiest of the sticky inflation, and it just hasn't budged in the last like six months or so. It's hovering between 4 and 4.5. The momentum, which is the 3-month annualized number, is lower, and the 6-month annualized number is also lower. So the momentum on Supercore seems to be good, but until you get these actual CPI prints moving in the right direction and inflation expectations moving in the right direction. And by the way, what will that take? Well, if you're not going to cut rates or raise rates, the Fed does have other tools that they can bring to bear, particularly the communications policy. Fed communications policy is very powerful. When they start talking tough about inflation expectations generally respond positively. So you should expect to see, if we get any more of a surge in inflation expectations, that the Fed is going to start to talk a lot tougher. That might be bad for the stock market. If the Fed's talking tough about inflation, that means some folks are going to start pricing in higher for longer and maybe eventually rate hikes. And if they do, the stock market's not likely to be immune to that type of a development. This is just more data from Bloomberg on what exactly the rate situation is and what rate cuts are priced in. Here's a better chart to highlight it. This is rate hikes expected in 1 year forward. So there were 9 rate cuts priced in September, but subsequent to the September 18th, plus or minus, we had, I think, when the probability of a Trump victory started to look more likely, we started to price out. We got four rate cuts. There was 9 priced in. So now we're back down to 2 rate cuts over the course of the 12 months. So at least 75 basis points of potential Fed rate cutting got priced out. Probably, again, as it relates to the probability of success in the election for Donald Trump, it meant pro-growth policies in a fully employed situation and environment here in the U.S. that could potentially put a floor under inflation, and we may actually see, and if you get tariffs, that would also be challenging for the Fed. There are some Federal Reserve officials, some that I've spoken to, and Chris Waller would be one. He's a Federal Reserve governor who believes that the tariffs would be transitory, a step function up, so the Fed could look through it. And that's a possibility too. We just don't know how the rest of the voters on the FOMC would react to continuously higher inflation prints. If they go higher, I think we know how they're going to react, but we just don't know. Again, going back to the main theme of the webinar today, policy uncertainty. We just don't know yet. There's there's lots going on, but a lot of things are not going to be resolved anytime soon, and hence we should try and focus on what we can control and try and make some judgments given our best understanding of what's going on in Washington and what's going on at the Federal Reserve and where we are in the economy. And right now, we think the economy is likely to be between 1% and 2%. So near trend or a little below. A little below would be better because it would help inflation start to bump down a bit. Hoping it's going to stabilize a little higher than the Fed's target, and that would cause if it does, we get both a little lower in growth and a little higher inflation, it might give the Fed scope to cut. But I think the base case for 2025 has to be 0 or 1. Julian, you're on mute.
Sorry, a few questions that we will again preview the next section on AI and the concentration at the top of the S&P 500. Clients are wondering how to position and what are the implications for the equity side of their portfolios.
So the implications are, and it's important to remember a couple of things. If our clients achieve what the market's offering, plus or minus 100 basis points at the portfolio level between now and 10 years from now, then we've done our jobs. That's it. We need to try to protect assets when we think that things are in a bubble, which we don't. We need to move assets around slightly around a client's risk profile, whether it's a 70% equity, 30%, 60-40, 50-50, whatever the risk profile is, maintaining a strategic weight that averages to the client's determined risk profile and achieving, more importantly, once we are close to the weights, maintaining a portfolio that actually achieves those results is our mandate in our view. And trying to, it's not a binary decision to take equity risk or not take equity risk. It's not that important to us, and it shouldn't be that important to our clients if one line item like large cap growth underperforms or outperforms, or international value stocks underperform or outperform. The only thing that matters to achieving your financial objectives is achieving benchmark-like returns, which means getting what the market's offering you over a period of 3 to 5 to 10 years. That's it. Everything else is secondary considerations. We care about them. I'd like to have every one of our managers and line items outperform. But the most important thing is to build a portfolio that's all weather, that achieves the right risk and return, particularly return. Those things are exactly the same, risk and return, that achieves the return necessary for you to achieve your financial objectives, whether that's making endowment and foundation payments at a particular spending level, whether that's achieving a retirement with certain spending that you want to be able to achieve with an endowment 5 years from now or 15 years from now. That's our job. So I just want to highlight that to start. In terms of what we should be doing, given the level of concentration, let's go through a couple of slides, and then I'll reiterate the point I just made, which is you want to be aware of it. It does increase some volatility. We have addressed it to a certain extent by nudging the portfolio out of some of the what we would consider high-flying but not bubbly mega cap tech stocks or the Magnificent Seven, given their concentration. Here's 2024, by the way. Apple is 7% of the index, NVIDIA 6.4, Microsoft 6.4. If you go back just to a couple of other epochs or periods, in 2010, the biggest stock in the stock market was ExxonMobil. Apple was second. It's 3 times as big now as it was back in 2010. But Exxon was on the list, Chevron was on the list, IBM was on the list, P&G, Procter & Gamble was on the list, AT&T, Johnny John, JP Morgan Chase is still there. Apple is still there. NVIDIA, nobody knew who that was back then. Amazon, it's just unbelievable. Going back to 2000, it looks a lot like the 2010, along with the 1990s, IBM, ExxonMobil, Philip Morris, et cetera. But the biggest stock in the index at 7% is now just light years ahead of the biggest stock of the index back in 2000. It's almost a double on what GE was back in 2000. So you do have a very unusual period of time where concentration is not only the biggest stock is bigger than most, but the top 5 or 6 stocks are about as big as the biggest stock was in any other period. That is, if you go down to, down to Amazon, which is the 5th stock on the list, 3.8%, that would have been the top of the list in any other period that we're looking at. So we've never seen the top 10 be such high levels of concentration. It's 31% now, whereas the Mag 7, just going back, a little bit ago, you couldn't, back a couple of years, it was still large, but 22% to 30%, 31% since 2020 for the Magnificent Seven. Interestingly, it's not just the contribution in terms of market cap, but the contribution to performance in terms of percentage points. So in 2024, the S&P returned 25%. Almost half of that came from the Magnificent Seven. This is the contribution. NVIDIA contributed 5.5% of the index is 25%, which is absolutely shocking. But does it mean, it's a bubble, or does it mean it's something we should track, something we should be aware of? But there's not an obvious thing that you want to do because of this information. The weight of the top 10, let's see, this now is it's continuing to move higher. What we have in terms of economic contribution in the top 10 stocks, what you want to know is not just its market cap contribution to the S&P 500, but in terms of R&D expenses, the Magnificent Seven contributes 40% of R&D. It contributes over a quarter of the free cash flow of the S&P 500. It contributes only 10% of the employees in the Mag 7, but that's still a lot, 13% of sales, but 26% of free cash flow of the S&P 500 is coming from the Magnificent Seven. So you could make an argument that there's some justification for it. There's another chart I want to show you in a sec, but I want to mention DeepSeek just for a second. Obviously, that caused some difficulty in the AI stocks 2 weeks ago when it was announced that a Chinese-based AI firm might be able to do what OpenAI ChatGPT does with a whole lot less cost. And that, if you can do what DeepSeek says they can do, and it's not been verified yet, with less hardware, then folks like NVIDIA, Marvell, and Broadcom, those companies, the shovel makers for AI, are likely to get to see lower growth, lower revenues, lower EBITDA growth in the future. And it would also likely mean a rebalancing of growth prospects from the shovel makers to the users, which include Apple. So it's not all bad for the mega cap tech stocks and the Magnificent Seven. It's just it's a rebalancing from the shovel makers to the users. That day on January 27th, by the way, saw the single largest drop in market capitalization, one-day market cap of any company ever. By the way, here's the top 10 market cap drops. This is more than $500 billion, just FYI, $589 billion. All the blues are NVIDIA. So NVIDIA is 8 of the top 10 largest market caps. Different days, a lot of volatility. It's been a great investment, but just be aware it hasn't been a straight ride up. You are going to get some volatility there. Meta and Amazon are the other two that show up in the biggest single-day market cap losses in history. I just want to highlight just one thing real quick, and then I'd love to take some more questions. Where are we in a bubble in AI? Probably not. I'm going to show you a slide next, but a bubble generally progresses in a particular way, and you don't know where you are in that bubble process, whether it's the initial excitement of the displacement of a particular technology, or if it's the rapid increase, then you get a boom. If you're in the peak, it's a euphoric period. And then the first movers, the savvy investors, tend to start selling, and that's the profit-taking phase. And ultimately, you get a full-blown correction when there's a panic. But where are we? We don't know. I'm not so sure there is a bubble, because here's what's happened to EBITDA at NVIDIA. NVIDIA looks like kind of a speck here in terms of its earnings before interest, taxes, depreciation, and amortization, or EBITDA. EBITDA back in 2017 was something on the order of $2 billion. $2 billion. That's still a pretty big number, but it's not that big a number. And they surprised by 230 million. So the surprise is orange, and the actual reported EBITDA estimates are here. So the reported numbers are the combination of the two. So you had a $2.4 billion EBITDA in 2017 for NVIDIA. Then you had these two significant periods in between COVID of a crypto and an AI boom. And during the crypto boom, you went from, call it 2 to 4.5 billion, so doubling. And then you had a bit of a, kind of a leveling off, not really, but not too bad. These are the growth rates here, by the way, in purple. But during this AI boom, what you've seen is absolutely extraordinary, and it supports, to a certain extent, the price. Whether it can continue, we don't know. But in 2024, NVIDIA is going to report $38 billion of EBITDA, or did report 38 billion. 35 was the estimate, plus 3 is the surprise. They've been able to positively surprise every year, in addition to having massive amounts of growth in their EBITDA to date. Now, this is 85 billion. It's the 2025 estimate. Are we going to get to 85 billion? Time will tell. But that would be another 120% growth in EBITDA. But I just highlight this because stock prices can go up for various reasons. The best reason is massive and consistent EBITDA growth. So now we're going to jump into the final section. Any questions, Julian, or shall I talk a little bit about how to position the portfolios?
Yeah, just go ahead. I guess we'll have a few questions we can address, but I'm sure you can answer most of them already.
Julian wrote a paper last quarter on U.S. exceptionalism. It's gotten a lot of play. A lot of folks are talking about not only Julian's paper, but also the topic of U.S. exceptionalism and how for the last 10 years, most all of the last 10 years, except for 1 or 2, the U.S. has significantly outperformed non-U.S. stocks. And the reasons for that are discussed in a great detail and very convincingly in the paper that Julian's written, but they really relate to the strength of the market and the ability to put capital to work profitably here in the U.S. The reason that you might want to reduce your exposure to international isn't just because it's underperformed. This is not a reason to reduce your exposure to international. Because it's underperformed the U.S. That would actually be, as a trader, as an investor, that would be a signal to maybe buy it. So there's a valuation argument here, but you only want to include other assets in a portfolio context. This is modern portfolio theory 101, Harry Markowitz. You only want to include other assets if they provide a diversification benefit. And the diversification benefit of international equities outside of EM has declined pretty dramatically. The U.S. enjoys substantial foundational support, ease of doing business, transparency, deep liquid, corruption-free capital markets. These are things that accrue to the benefit of companies that are based here in the United States. In addition to our human capital and the research institutions and universities, which have developed a culture of innovation here in the U.S., these may be enduring advantages that we can continue to rely on. I'm just going to show 1 or 2 slides here and then bring the conversation to a close. The idea that your return on equity and your return on assets is much higher. What you see is the return on equity is about 18%, here in the U.S. and has jumped recently. The return on equity in EFA, or the European, primarily European countries, East Asia and the Far East, is 13%, whereas emerging market return on you deploy capital in the emerging markets, and recently you've gotten much lower than the U.S. Return on that capital in emerging markets. Same with return on assets. So not surprisingly, these two profitability metrics basically show a pretty significant justification, and they do vary, but they seem to vary in a way that is consistent across time. You had a little bit of a reversal back in 2010, 2011, when the epicenter of the financial crisis was here in the United States. But subsequent to that period, it's been all U.S. And you should expect maybe that to continue. There's a valuation argument to be investing outside the U.S. The PE ratio is price to sales and price to book, but the PE ratio is what I'll focus on. It's 27 times here in the S&P, where it's just under 15 in emerging and just under 14 in EFA. There's always a discount for non-U.S. stocks, but this is a couple standard deviations away from historical discounts. And finally, I mentioned that one of the reasons why you would want to maybe reduce exposure to non-U.S. has to do with the diversification argument. when the correlation between U.S. stocks and international stocks, international developed is close to 90% now, whereas in emerging markets, still less than 70%. So the point of the chart here is that emerging still provides some diversification benefit, and developed markets maybe less so. And then finally, as it relates to do you have a question about U.S. exceptionalism, Julian?
No, I guess I was going to start throwing some questions on some specific items. So, in equities specifically, there was a question about China slowing down and how that impact the equity side of the portfolios.
Well, we're call it market weight invested in China. Again, what's happening, outside the United States, we have somewhat less visibility on, and certainly corporate. China's the biggest entity in emerging markets. If you're invested in emerging markets, you're going to be exposed to China one way or the other. You could avoid it. There's a lot of products out there now that allow you to avoid China. I just have a strong feeling that I don't have good insight into how China is going to perform, which is really, as investors, what we care most about. Again, absent other considerations, other political considerations related to China, the tariffs aren't going to have that much of an impact on Chinese equities. I don't think here in the United States. I think we're going to see continued growth in emerging markets at a particular level, and you should be exposed to them, be my view.
I can ask another questions on the fixed income side that for a change. So I guess the one would be about the impact on munis and corporate bond, of the policies, and what do you expect this year?
So there's two things going on in DC that I've heard about. One is removing the municipal bond exemption, and it's kind of a very low level discussion, so you can ignore it. It's never going to happen. Munis are the foundation of a private client's fixed income allocation, and there would be hell to pay if that got any traction. The other is privatization of Fannie and Freddie. Those are other policies that might get some traction in DC. I don't see either one of those having a tremendous amount of impact on clients one way or the other. Removing the conservatorship of Fannie and Freddie is probably long overdue, but it's not as big a part of the market as it was 10 years ago or 20 years ago. The taxable bond market, which includes treasuries, mortgage-related, agency, which is Fannie, Freddie, and Ginnie, and corporate bonds, the composition of the agency debt is much lower than it was 15 years ago. So I would say there's really not the biggest impact on fixed income as it relates to the administration's policies are the overall macro policies, which we've discussed. And the overall macro policies for bonds are kind of a mixed bag. Probably good for growth and credit, and that means good for credit spreads. Probably depending on what actually gets implemented, whether it's a negotiating tactic or whether you actually see an implementation of significant tariffs. It all boils down to how you feel about where inflation's headed. I think the Fed is quite credible. They're going to do what they need to do. They'll wait and see before making a move on what the policies are that are actually implemented, as opposed to the negotiation of those policies. And then bonds will react accordingly. If you do get significant a spike in inflation, then you're going to see bonds. They're much better positioned now than they were 3 years ago. 3 years ago, bonds came into the year 2022 at near all-time low yields. Now you've got some cushion at 4.5% and 10-year notes. You've got a fair amount of cushion to buffer. If you just sit tight, you're going to get 4.5%. You need interest rates to go up 100 basis points before it wipes out the income of a 10-year bond now, whereas you needed like a 25 basis point increase, and it wiped out all of your income for 2 years, 3 years ago. So bonds are back. They're a good hedge again, and they do have some value. Julian.
Yeah, we still have another 5 minutes, and I'd like to squeeze a few more questions. I'll start with one, and if you can answer quickly, because we don't want to spend too much time on that. Bitcoin and gold, I guess let's put them together. What's the firm view? What's your view on these assets, if you can call them assets?
You can call them assets. The reason we don't necessarily include cryptocurrencies is it's the view of our investment committee that we haven't been able to identify how to trade them. That is, what's the valuation metric that says Bitcoin is rich, cheap, or fair? And without that, as an asset allocator, it's impossible for us to include them, especially as Bitcoin and cryptocurrencies aren't part of the benchmark. And if they're not part of a client's risk profile benchmark, then the addition of them has to be done very thoughtfully and with a strong level of conviction. And it is, even though Bitcoin has enjoyed a pretty spectacular run up in the last, 6 or 9 months, it's really a volatile asset class. Gold's different. Gold at least has what I would call a history of being a store of value, which Bitcoin lacks because of its volatility. Gold is volatile, but it's 1/10 as volatile as Bitcoin. So if you're looking for it, so that makes Bitcoin not digital gold. Digital gold would likely have a whole lot less volatility to it to be able to claim that moniker. So gold has done very well because of geopolitical risk, and potentially because if you think about not being, if the administration and policymakers in Washington, D.C. are unable to deal, and Congress in particular, are unable to deal with the budget situation as it currently stands, and we continue down this path of 6% deficits for as far as the eye can see, it's going to be better for gold than just about anything, because it will continue to see increasing supply of treasury securities, which will cause interest rates potentially to rise, which will cause damage to our standing as a reserve currency, and ultimately, and it's not in our base case at all, it's a complete risk case. In the next 20 years, it's a risk case. We might actually see a deterioration of reserve currency status here in the United States, and that would not be good for the U.S. and U.S. asset holders. But it's not a near-term risk at all. It shouldn't be viewed as that. Julian.
Okay, Michael. Second to last question about alternatives. So we're big in alternatives. That's something we promote. So can you explain again the case for alternative in the portfolio and private equity and private credit in particular?
So what we've determined is that if clients are going to be exposed to a particular risk profile benchmark that includes equities and bonds and real estate and things, you can either access those through publicly traded markets or privately traded markets. So when we say alternatives, we basically mean the private market vehicle of public market risk exposures that you would access anyway. That is public equities. That's stocks that trade on the New York Stock Exchange, large, well-established. Private equity, smaller companies, not well-established, but the same risk factors, maybe a little more small cap growth type risk as opposed to large cap or type risk. So there is an additional what I would call fundamental risk factor, but a lot of what you get in alternatives in private alternatives like private equity, private credit, which is as its analogy in corporate bonds or bank loans, primarily bank loans or credit that's traded publicly. Private real estate has a direct analogy in things like REITs, the equity REITs that you can buy on the stock market. By exposing yourself to the same risk factors, but in a package that isn't as volatile, that has some liquidity lockup that you can't access immediately, which I think is a very good thing for clients. You get paid a lot to give up the liquidity to go into alternatives. Alternatives, to me, just to put a fine point on it, they're really just the private vehicle exposures to the same risk factors that are in a 70-30 benchmark. And if you can do what we've done historically at Beacon Point, which is do the due diligence necessary, understand what the risk factors are, get to know the managers, stick with the ones we like for years and years and years, then you can substitute some of your public market exposure for private market exposure to the extent that you're comfortable giving up liquidity and get paid a lot more to do it. That's the case for alternative.
Thank you, Michael. And I guess the one final question I think will be a great way to finish this webinar is about, once we've done the asset allocation, who and how do we make decision about portfolio position?
Once we've done the asset allocation, who makes a decision about portfolio positions?
Yeah, like once you decide between equities, fixed income, alternative, like the managers we own, securities we pick.
Yes. Great question. Very simple. The investment committee, in conjunction with many of the partners on the call today, who are involved in the manager selection process through the traditional investment committee. That traditional investment committee is our manager research committee that attempts to and has successfully found very high quality managers that achieve client objectives. Same for equity managers, bond managers. It's a very thorough process. It's a process that's rooted in our history at Beacon Pointe of being an institutional consultant for foundations and endowments, where, frankly, risk-adjusted return is demanded from our clients for the institutional clients that we have on the books. And our private clients get the benefit of that. So the investment committee makes all the portfolio construction decisions for our strategy portfolios, but there's a lot of customization done at our partner offices to allow for various preferences of our clients, preferences of our advisors, in order to deliver not just the risk-adjusted return a client needs to meet their financial objectives through the plan, but also to address any utility that they derive, for example, from impact type investing. So there's I would say the overall direction is set at the investment committee, but there's a fair amount of customization that can be done for clients at the partner office level.
Do you want to present the last slide about timeless investment lessons?
Oh yeah, yeah. I'll leave it up there as we close because we're at 90 minutes right now. I just highlight the fact that having a consultant, having an advisor help you to navigate some of this, the noise, and to try to find the signal is, it's more helpful. It's easier to do if you take a long-term approach. Stock markets are going to move up and down. It's more of a random walk than anything else. And the only reason you should be significantly changing your asset allocation is if you have a significant liquidity shift in your profile. Most people don't. And you should always be diversified. There's less of an argument for international equity diversification now than there was 10 years ago, but you should still have some, especially in the emerging markets. And really, when you're thinking about whether to, whether you're achieving your objectives, whether you're on the right path, or whether you're going to be derailed from achieving the objectives of your financial plan, there's only one thing that matters, and that's the return you're getting at the portfolio level. I mentioned at the very front of the discussion, don't worry about individual line items. Don't worry about your equity manager, your bond manager outperforming their individual index. Think about the overall portfolio results versus your risk profile benchmark, and know that we take risk management very seriously. Julian, Nick Coletta, other members on our team are doing a lot of great work on modeling the portfolios and running them through state-of-the-art risk modeling, including Bloomberg Port and BlackRock's stripped-down Aladdin version of Green Package. All of these things come down to one really very simple thing. Identify what your objectives are. Make sure your advisor is building the portfolio that actually achieves those objectives, and that's what we do using the risk modeling tools. And then really measure and manage the risk and stay invested. So don't be afraid of market volatility. Don't be afraid of the noises that you're hearing on CNBC and elsewhere. All of this is part and parcel of what we're digesting on our end in an attempt to get you where you want to go. But staying invested and knowing that we're on top of it is probably one of the things that we can offer at Beacon Pointe. I'll leave it at that, Julian.
Thank you, Michael. And thank you, everyone, for joining us today. Please look out for our invitation in your email inboxes for our next quarterly and macro update that will take place on May 8th. See you all next time. À bientôt.
Thanks, everyone.